Tesla's fourth quarter results are out, and there are a number of changes, and we've made a number of updates to our model. So we weren't going to actually do a video for this recap. We were just going to keep our updates on our model blog. But there's just so many things to go through that we think it's worth taking a few minutes to take a look at it. So on the left-hand side of the screen, we've got the Tesla update letter for shareholders, and we've scrolled down to the guidance section. And it's not as vast as it was last quarter, but there are some really good important things here. And we've highlighted these items on our blog. So if you go to click our model blog from gutenbergresearch.com, you can see that we've left bullets of just the key management guidance items, and we've also given a summary of the updates in our model, along with our EPS and valuation changes, and then the model saved here too if you want to download it. So let's get into the guidance, and there are three main things that we want to talk about here. One is the implied revenue guidance based on the delivery and average selling price guidance, the gross margin guidance, and the operating expense guidance. So on the average selling price, they didn't actually break down the average between Model S and Model X, so we had to do a little bit of calculations. So if you take our model, scroll down to the segment details, you can see we've added a couple of key metrics. So we've added this average vehicle check calculation and average vehicle gross margin calculation. So since now we're disaggregating the results between Model S and Model X, we need to do a little bit of work. So you can see that in these past periods, and this is actually current, so we will change these. In the past periods, we have some blue cells, which represent our estimates for average selling price and gross margin, and that's because they're not disaggregating it between the two vehicles. So you can see up here, we've got the total automotive non-GAAP gross margin and total automotive average vehicle price. And we've put these checks in place to make sure that whatever assumptions we put in for the Model S and the Model X gets us back to the total auto average. And what we found is that our average selling price estimates going into this release were probably a bit too high, and that's just based on the guidance that management gave us over the last couple of quarters. So starting with the ASP for Model S, this is sort of how we backed into this number. So this is not a number that management gave us, they just gave us a couple of comments. So first of all, they say that the Model S declined about 2% in the fourth quarter. And if we assume that the Model X contribution for 3Q15 was minimal, which we know that's probably only about 50 vehicles or so, and we brought our ASP down to maybe like 110,000 per vehicle, and again, that's just an estimate, we're not really sure what that number was. That would mean that the average selling price of Model S, which made up the rest of the auto segment, was about 96,500 in Q3. And then we took that 2% decline that management mentioned on the call tonight, and we brought that average selling price down, so that would give us an average selling price of just under 94,000 for the fourth quarter, which is sort of in line with the trends and the things, the puts and takes that they spoke about on the call, and the fact that it was impacted by the strong US dollar. Then from there, we can back out the zero-emission vehicle revenue, which they said they didn't have any, but they actually were able to sell about $8 million in credits for the quarter. And we can use that to derive the remaining revenue for the auto segment. And we can back into the Model X average selling price using the total deliveries of 206 vehicles that they gave us. So that would be about $120,000. And then this check is basically making sure that the auto revenue that's reported on the income statement is in line with our estimates if you basically multiply our estimated average selling price by the number of units. And if it were not the case, then this check here would spit out an error. So that's how we backed into the fourth quarter average selling price for both vehicles. And the reason we did that is it's important to know what this ASP is so that we can forecast the earnings going forward. So now with this lower than what we had originally anticipated ASP, we revised our selling price for 2016 downward. and for the Model X as well. Then we took the one piece of guidance that management gave us on ASP, and that is that the total for the auto segment is going to increase slightly. And for slightly, we took it to mean they would go from about 95,000 to about 100,000. And we had it gradually increasing throughout 2016. And we coupled that with the guidance that they gave us on deliveries. So they said that deliveries would be 16,000 total vehicles in the March quarter, and between 80 and 90,000 for the full year 2016. So we just took the midpoint of that range. And you can see that we have an upward sloping ramp of those vehicles. And then one other key point that they mentioned was that the share of the Model X to total deliveries was going to increase throughout the year. So we have it increasing as 6% of share, 7%, 9%, then all the way up to 25% by the fourth quarter of 2016. So our ASP and delivery expectations are within management's guidance. So as a result, our total estimated revenue should also be close to what management is forecasting. So that takes care of the revenue line. Next, we're going to talk about the gross margin as we work our way down the income statement. So for gross margin, let's go back to the shareholder letter for a second. They did give some good guidance here. So they said by year end, Model S gross margin should begin to approach 30%, and Model X gross margin should be about 25%, with continued improvements for Model X in 2017. One thing they didn't mention here but came up on the call, an analyst had asked when they had expected to get to, or where they expected to be on the gross margin front in about 18 months from now. And Elon Musk didn't want to answer the question, but he was basically saying that he hoped that both vehicles would be at about 30% gross margin at that point. So there's some really good points on gross margin. So we had to actually increase our estimates. And basically we know that the Model S gross margin most likely came down because the total auto group gross margin went from about 24% to about 21% in the fourth quarter. So we had to tweak our gross margin in 2016 downward. But then we have it upward sloping because they're saying that Model S would reach 30% by the end of 2016. And keep in mind that what they're saying is it's going to approach 30%. So the average for the full quarter of the fourth quarter of 2016 won't actually show as 30%. So we left it as 29% here. And we brought it to 30% in the following quarter. And then the same thing with the Model X. They're saying as it ramps and they get some leverage on their equipment and everything, it's going to increase pretty rapidly. And they said that it would approach 25% by the fourth quarter. Same deal. We left it at 23%, just reflecting the fact that it probably will hit that target at the end of the year. And then we get to 25% in 2017. And then if you look out further, once we start approaching that 18-month period, which is about here, we actually gave a little bit of additional time for the Model X. So we have both vehicles reaching an equal 30% margin by the end of 2017. And that was key. That actually helped our earnings estimate, and it helped our DCF valuation. So that takes us down to the gross profit line on the income statement. And from there, we just have R&D and selling and general and administrative expenses to get back to our total operating income line. And for the operating expenses, management did give some good guidance here. So they said that for Q1, operating expenses should increase just slightly from Q4. And the full year operating expenses should increase by about 20%. And that's to reflect the fact that they're going to be ramping the Model 3 development at that point. So when we look at the March quarter, we have increased non-GAAP operating expenses to what we think is just slightly. So we have it up about 2 or 3 million, so nothing really large. Then on the call, they did say that it would be a steady increase in operating expenses throughout 2016. So you can see that we've actually increased OPEX every quarter through 2016. And for the final year-over-year growth rate in OPEX, we capped it at 20%. And the way that we got there, if you scroll down to our ratio section below the deliveries, let's see here. So we have research and development and selling and general and administrative expenses as a percentage of revenue. So for R&D, our fourth quarter R&D was actually much lower than what we had originally anticipated, and our SG&A was much higher, or not much higher, but slightly higher. So we increased SG&A and we decreased R&D, and then we brought both down throughout the year, consistent with management's guidance. But we capped it at 20%, and that was actually pretty difficult because we were getting it, the way our model was calibrated before, we had OPEX increasing much more than this 20%. So once we put those factors in, we can take a look at what our new EPS is. So if we scroll to the bottom of the income statement, you can see we were valuing shares based on a December 2016 EPS. Prior to the release, we had estimated a $1.54 of EPS for the full year. Now, with these new model assumptions, we move to a $1.90 EPS, and the net debt per share increased to $10.84 from about $4. So that also impacted our market multiple valuation. But keeping our multiple constant at 99 times, we were able to get back to a price of $177 on a PE basis. And with these new assumptions, our DCF-based valuation moved from $162 yesterday to $173 after this release. And we kept our beta and equity risk premium, weighted average cost of capital, and terminal growth rates all constant for that valuation. So when we do a 50-50 weighting of the two approaches, we get to a price target of $175, and that's up from $155. So overall, the increase in shares and after hours does make sense. There's still a ton of execution risk here. Management has stated, and this is sort of one of the most important points in the call, before the call we were saying that we were a little nervous about the cash burn and the CapEx, considering Model 3 would be ramping soon, and whether or not the Model X cash flows would be able to produce enough early on to meet those CapEx requirements. And that was one of the main points that management made, was that they do not anticipate the need for any external funding over the next year. So if that is in fact the case, then shares could go much, much higher. But there is execution risk there, and they're ramping a number of products at the same time. So there's definitely some downside here, but we think that the price move in after hours does make sense based on this new guidance that management provided. Now, if you'd like some additional details on the difference between our PE and DCF approaches, we have an education section on our website, gutenbergresearch.com, and we have a video that goes through the discounted cash flow valuation as well as the inputs to the DCF, including the beta, equity risk premium, and weighted average cost of capital that we spoke about. And we also describe the difference between the market multiple valuation and the DCF valuation. Within that description, we talk about why a growth company like Tesla would have such a high near-term price-earnings ratio, and that's due to the fact that the market is not valuing the company based on earnings that they're going to achieve next year, but many years down the line. It's because it's all about the long-term earning capacity of the company, and we describe that in our video. So definitely take a look at that. And if you're interested in financial modeling, please subscribe to our YouTube channel and follow us on Facebook for all of our latest updates. Thanks for watching.